Welcome to another edition of Think with a Drink. This is the weekly webinar series brought to you by the ARIES Foundation for Financial Education. Tonight's episode is reverse mortgage. It's a good idea, bad idea, what's involved with this whole thing. You've probably heard some stories, good, bad, or indifferent, about reverse mortgages. So we want to touch on a little bit about reverse mortgage. Next screen, a little bit about the pre-flight checklist. How did we get there? Past that, we don't need that. Who needs a checklist? Next screen. All right, we're brought to you by the ARIES Foundation for Financial Education. My name is Tom Alessi. I am the president of the ARIES Foundation. I've been in financial services for over 23 years now. I'm an investment advisor. That means I act as a fiduciary whenever giving guidance or advice to any of my clients. I'm going to bring my vice president, Craig. Why don't you introduce yourself?
Sure. So I'm Craig Richardson, the vice president of the ARIES Foundation. I've been in financial services a little over 18 years now, and I specialize in working with families to help them get a handle on their money and have a better future.
So you can visit the website ARIES. It's www.ariesfoundation.org. We're a nonprofit located in Newton, and the mission behind ARIES is trying to help everyone have a better relationship with their money. Because whether you realize it or not, you are in a relationship with your money. And just like every other personal relationship that you might have, there are emotions and behaviors and triggers that can cause us to act, well, Craig and I like to say, a little irrationally sometimes when we're dealing with our finances. So all we try to do at ARIES is try to help everybody take a little bit of emotion out of dealing with their money. Next slide. And we come to the fun part of the evening. We call this Think with a Drink because we want to be a little bit more casual, a little bit more relaxed in terms of our topics. This one comes to us by Bent Water Brewing. This is called Jolene. It is a porter. While somewhat darker and a little bit heavier, it is light and very refreshing and enjoyable. Skål.
Cool.
Next slide. All right, so the pros and cons of a reverse mortgage. So one of the reasons that somebody might get themselves into a reverse mortgage is that, you know, what have you been told forever about a mortgage, right? That you should pay it off, right? Pay it off as quickly as you can.
Right, and about 50% of the people who retired who own a home at 65 have paid it off.
They've paid it off, which always feels good. Say, that's it, I don't have any more mortgage payments. But you know what happens then? You're house rich and cash poor sometimes, right? So what happens sometimes for retirees, senior citizens, people who are elderly, they're living on a fixed income, they're living on a fixed budget. And as we are experiencing this year especially, where inflation has been, you know, jacking everything up and increasing prices, sometimes that can be a bit of a strain and a stress, especially on the older and especially with those on a fixed income. Well, again, that's great that you've paid off the property, but now how are you going to access the money that's in there?
Well, the other thing that people don't think about too when they're talking about I'm going to pay off my house before I retire is the fact that the mortgage becomes the smallest part of the payment. It's really the property tax and insurance that keeps increasing over time, and that stays with it regardless of whether the mortgage is paid off or not.
Right.
So there's still a need for money to maintain the property.
And so traditionally, you really only had two avenues to access the equity in a property. You could sell it, or you could get another mortgage, a home equity loan, or you know, line of credit type of thing. So what they came up with was this third option called a reverse mortgage, which is another way to access that equity, the money that's sitting in your property, should you need it at a certain age, at a certain level. Next slide. You know, so that's the idea, like we said. The whole point is that, great, I paid this off, now I'm sitting here with all of this equity, but I'm house rich, but cash poor.
Can I just put an ATM in my wall?
Yes, or just take the door off and go down to the bank and try to use that. So next slide. Right, so a reverse mortgage is a loan, but you don't make payments on it. right? What they're doing is they're taking it against the equity value in the property, right? So you're not making payments. Unlike if you took out a home equity line or a line of credit, you've got to pay that back. Now, there were some bad behaviors, some things going on in the industry that were, you know, a little bit sketchy. Let's put it that way.
Right. Well, it allowed people to access a lot of money in a short amount of time.
Yes.
Right.
And so what they've put in place now, you have a lot more safeguards, you've got oversight, you know, you've got government-backed mortgages that are being used. So there's a lot more in place now in the reverse mortgage industry than when they first came in play, and you know, you heard some horror stories that went on in terms of that.
Well, it's like anything that happens. You know, it's always the Wild West at first, and then all of a sudden regulation comes into play after people have had, you know, not so good experiences. So, you know, like Tom Selleck says, I wouldn't do it if I didn't trust it. I wouldn't talk about it if I didn't trust it. They've come a long way, and there's a lot more, like you said, safeguards in place than there ever were before.
Yeah,
so.
Absolutely. So next slide. Right, so how much you can get, this is a bunch of different factors that go along with that, right? So, you know, one of them is the appraised value of the home, right? So you've got to have the appraisal done. That's usually rolled into the cost. That's usually part of the home reverse mortgage cost, right? So again, you're not paying for that out of pocket. The older you are, the more you're going to get because you won't be using it as long. So they're looking at it from that perspective. The older, the less period of time that you're going to have that note outstanding.
Right. And in this particular case, I believe, you know, some people, what if I run out of equity? What if I run out of money? And I believe a lot of the mortgages now are almost like an annuity. In fact, they pay you for the rest of your life.
Right, so there is some part to that you can set up in terms of dealing with it, right? Again, that's some of those safeguards that are in place. So it's to say, like, I didn't burn through the whole thing in the 3-year time period, right? You know, in terms of going through it, right? The interest rates now, however, are changing. So just like home mortgage rates, they're going up. So that happens with these rates as well. Now that just based on how much you can get and how much gets paid back is really the position to that. So just know that when interest rates were lower, just like getting a home mortgage, right? If you were applying for a home mortgage and the interest rates are lower, you could borrow more because the monthly payment was less.
Right, so this is just like, you know, it's nice to have that equity. As you hold the property, hopefully equity goes up over time, right? So it just keeps increasing. And because the payout rates get better as you get older, this is a great called longevity insurance.
Correct. That's the idea behind it. And again, it's one of those tools that is available, not necessarily have to take advantage of it, but it's there, and just want to make sure that you understand what's involved and what are the proponents, you know, and what's the good and the bad of it. Next screen. You know, so this becomes that whole safety thing, right? So one of the things with it is there is no prepayment penalty. And, you know, this would only happen should you either come into a chunk of money that you're going to use to then pay that off, or you sell the property, right? And what happens in that situation, you sell the property, they take their note, you take the money that's left over, it's yours, you go your separate ways, right? So you can never owe more than what the property itself is worth. So that's one of the things with a non-recourse loan. That's the appraisal and the valuation to it. They are always going to recommend that you go through and sit with a professional, somebody who is going to be unbiased, who's going to talk you through it, go through the pros and the cons, the ins, the outs, what makes sense, what doesn't make sense. And part of that is, and we recommend this to everybody, is bringing in a family member, bringing in that other person who's going to hear some things that maybe you didn't hear, or maybe you didn't understand, and you have somebody else that you can voice it off. Dealing with seniors, dealing with the elderly, this should happen all the time anyway.
Well, one of the big issues that happened when they first came out with reverse mortgages was that people didn't understand, because when their old mortgage incorporated their tax and insurance. They didn't realize when they did a reverse mortgage and now the bank's giving them money that they're now responsible for their tax and insurance.
Right.
And so all of a sudden they were getting into debt on the tax bill because they weren't paying their taxes on the property. So it's why you want to go through the counseling and make sure you understand all the ins and outs of what's going on, the pros and cons.
Right, and that's part of that financial assessment. That financial assessment is making sure that everybody who applies understands, and just like Craig had pointed out, that whole aspect of, are you able to continue to pay the taxes, the liability, the insurance, everything else that goes along with it, and you also have to do upkeep and maintenance to the property, because that's part of that appraised value. Origination fees, right? So this was one of those, let's call it more sketchier. I don't know if you can,
Well,
if you can
they
say
baked a
that
lot of
in
this
terms
in,
of,
yes.
you know, that this is where some of that was happening, where some of those fees that were being lumped upon, heaped upon, the contracts were maybe not within a regulatory bandwidth, right? So they've sort of stepped in on that. You know, now most of this is regulated. Most of this is like there's a certain parameter, certain level, certain percentage that you can have, just like you have with a mortgage. You got a mortgage with points. This is how that works. You got closing costs. You have fees that are associated with it.
Right. I think the issue is, you know, suppose when you've got your first mortgage, you're paying money in. The reverse mortgage, you're getting money back. So it's easier to be a little bit more liberal with the fees. When you're not paying anything in, you're receiving something.
Right.
But you are still losing because it comes out of somewhere.
Yeah. Right. And so that's the thing to understand, that this is always about taking the equity from your property. And that's one of the key points there is you can never get all of the money out, right? So they're never going to give you a loan for 100%. I think the level is like 70% and something. We may bring
Well, I
that
think you
up.
can get reappraisals later on down the road, like if it's a substantial amount of time and the market has changed.
Oh, and to take an additional amount.
Like it's happened the last few years and the market just cranked up.
Right. So now if I took it out, my appraised fee was 700, but now the value
worth
is
$1
$1
million.
million. Right. That you can do that, but it's one of those that
It's like a reverse mortgage refinance, right?
Yeah, right. That's the idea. But you're never going to get, like, if the valuation of the property was $1 million, you're not going to get $1 million, right? They won't do that.
Well, they have to have a little hedge built in for themselves, right?
Right. There's always going to be that level of float in between there. So just understand that as well. But for most people, the idea here is what you're looking for is I'm trying to offset my additional expenses, my additional needs, whether that be day-to-day living, whether that be for those additional, expenditures, property coverage, helping, the car broke down, the roof needs repair, those type of things that we may not have the money in the bank for.
Well, you spent all those years paying for the house. Now let the house pay for itself.
Right.
Right? So that way you can stay. Maybe that's what allows you to stay in a home that you've been living in all these years, as opposed to having to sell it to take the equity out and downsize.
Yes.
Right? So it gives you another option.
Right.
if you
It's
have that
another way
equity.
to keep staying in the home as an option. I just think it makes sense from that point of view. Next slide. Right. So this just talks about common uses, what people are doing with the reverse mortgage, right? So, in some cases, it may be as simple as it says mortgage payoff. Well, that's where we get into that conversation now. Like, I refinance. Like, if somebody refinanced when the markets went down, and they were in the 2s or the 3s, but took out a 30-year note at age 55 or age 60, and now you're in your 70s, right? Well, okay, suddenly now it's like, I don't want to keep paying this thing off, right? So like Craig said, let the house pay off itself. You can take the reverse mortgage and use it to pay off the mortgage, which then frees up money on a monthly basis.
Right, that income that you're now not paying that mortgage anymore. Right.
Right. For some people, they can use it to bridge, right? And when we say bridge, we talk about downsizing, finding that other place. A lot of times, especially now, just think of the last 2 years, right? The real estate market was off the charts in terms of trying to step in and purchase a home. And if you were really like, we just snowbirds, right? That's what they are.
Yes,
People
yes.
go south,
Go
right?
south in the winter.
So I want to go south. But in order to do that, I've got to have a chunk of money. I'm not going to qualify for a mortgage. I'm not going to be able to get a mortgage. I need that money so I can then go step in and buy a place, whether it's down in Florida or out in Arizona, down in the Carolinas, wherever it may be, so that I have that ability to do that. A reverse mortgage would allow you to do it.
Yeah, so you use a reverse mortgage to buy your vacation property.
Or just the next place you're going to go to when you decide, use it for a couple of months, go back and forth, and then relocate there and sell the property here.
Yeah, if you want, yeah, you could do either or, right? Gives you options. That's what I'm
Options,
saying.
that's the whole idea. And you can, like Craig talked about, have it be that almost like that annuity stream. Just, hey, I've got an additional amount of money that's coming in every month, right? So there's my monthly check, just like Social Security. Maybe I have a pension. Now I've got an additional amount that I can count on where I'm now covering all of my living expenses, all of my needs in terms of dealing with everything. Next slide. Right, so the cons, right? So this is where we get into that whole thing about the fees. So this is where you need to be careful. This is where you really need to be maybe doing some cost comparison, maybe looking at more than one provider in terms of doing this, because the fees, while we say, hey, there's regulation and things that have stepped in, as Craig said, it's still a little bit like the Wild Wild West. So you just, one company may be much different than another company in terms of closing costs and points and fees and how that's all rolled in.
Exactly.
But this is the same with a mortgage. Like if you were taking out a mortgage, it works the same way. Mortgages change one provider to the next.
Right, and then there also may be competition between providers as well. Who's giving you a better rate, who's giving you a better payout rate, who's allowing you to access more equity. So yeah, I think the bigger thing too is you also got to be aware of advisors who try to take advantage of the situation and go, oh look, we can take all this money out of your house and put it into this. And it's going to create this for you.
Yeah, that's a no-no.
Yes.
Beware of that, right? So that is one of those, like, wait a minute, what's going on here?
It should throw a red flag up.
Yeah, right. So there's the warning flag.
Doesn't mean it's wrong, but it means you should look carefully.
Yes. Right. There are aspects where that might make sense, but then also times when that possibly is just a bad course or bad advice in terms of dealing with. So just know those are some of the things that can happen. Like Craig said, it might be that situation where it could be putting the money at risk, which means that that lump sum that was supposed to last for the rest of your life now is no longer there for the rest of your life.
Correct. So just want to be cautious, that's all.
Yeah. No, cautious is very good. Doing your due diligence is is highly recommended.
And I think, like you said, getting a second mind in there to take a look.
Yes.
To get another
Oh yeah,
view.
always have somebody, a trusted, valued person that you know that you can turn to who can look at it. Next slide. Right. So the idea there is that you could wind up in the situation that the home, if the upkeep is not done, right? So if the home is not maintained, then you could wind up in a situation where the reverse mortgage holder could say, you are no longer can stay in this property, and you could get an eviction notice.
So you have to meet certain obligations when you take the reverse
Oh
mortgage.
yeah, no, you have to maintain the house. You can't let the house slide into ill repair or disrepair. You have to maintain the house.
Or unpaid taxes.
Right, and that's the other part. The foreclosure could come into play because, like Craig said, this happens, not any illicit way, but it's just merely
It's a perception.
yeah, just like, well, wait a minute, I had a mortgage for 30 years and my taxes were being paid as part of that mortgage. I thought this was the same thing and didn't get paid.
Right.
And so it could trip that up. You could trigger it. There are things that can happen that could put somebody at risk. You could wind up having to go into some sort of a care facility, and then all of a sudden you're not in the property anymore. Maybe there was a family member who was living with you, but where you're no longer the primary person in the house, they can't stay there. Because of the reverse mortgage, you have to be living in the property.
Right, but that is one of the acceptable things that you can use a reverse mortgage for, which is long-term care coverage.
Yes, yeah.
Right. Yeah, so I wasn't sure about the status of when you go into care, how that affects the house, but
Well, if you go into care in a facility, right, so you're no longer living there.
so it allows you to stay in the home and get care.
You can stay in the home and get care, absolutely, but if you leave to go to a facility, then if another family member is living there, not your spouse, they've got to go, right? Because that's a problem there. Next slide.
Well, if you're not expected to come back. Right.
Correct. Right, so just a quick overview, quick review on this, right? So the pros are that if you find yourself in that situation where you are house rich and cash poor, you now have the ability to access the equity where it doesn't involve selling the property or taking out a home equity line or a home equity loan where you have to make payments on it. So a reverse mortgage works in that capacity. You get to remain in the home.
Yay.
It's tax-free, and tax-free, you know, if you happen to watch one of our episodes where we talk about Medicare, you know, a reverse mortgage doesn't count against any of your other benefits. So you're not triggering a tax on Social Security, you're not triggering a surcharge on your Medicare premiums. These are all positive things, so it's tax-free, it's federally insured, and the funds are yours. Right. You can pretty much do whatever you want with them.
Well, because loans aren't taxable.
Right.
Loans aren't income.
Yeah.
Right.
So that gets around that whole thing, and the money's yours. You can pretty much do whatever you want with it. Like Craig said, for most people, the idea would be to set up and have that income stream, that payment thing that goes on to make sure that you're not outliving whatever the lump sum was that you took.
Yeah, like I said, I think it's a great idea if you have your retirement set up and now you have the equity in your home, it gives you that security blanket if I do live to be 90.
Right.
If I do live to be 95, if there is inflation that's beyond what I planned for, if I have long-term care expenses I wasn't planning on, that you've got that extra bucket of money to go to that's in place. That's your house taking care of you.
Yeah, absolutely. The cons, right? It can be expensive, especially now where mortgage rates, the interest rates have ticked up. So you got to be wary on that. And again, like we said, those fees, those closing costs, they can add up as well, right? You know, in some cases, you may trigger some, if you're on some other type of assisted care benefits, it can trigger a loss or a reduction of those types of benefits. You do have the risk of needing to keep paying the liability, the taxes, the insurance, all of that on there, and the upkeep to the property where you could risk losing the home if you don't do that.
Correct, yeah.
Yep, right. If you're thinking of this from I'm leaving the home, we get this a lot, as my inheritance, right? That's what I'm leaving to the next generation. Well, obviously using this is going to take away some of that benefit because you've tapped into it. Once you pull that out, that value in the equity is no longer there.
Right.
Which does cause some conflict, especially if the next generation thinks they're getting the home.
Well, I think whenever we do planning for people, we look at things in this order. Do you have enough income? Right, that's the most important. If you don't have enough income, nothing else really matters.
Right.
Do you have enough liquidity? And that's extra money to take care of those unexpected expenses, those things that come up, like the long-term care issue, something breaking, the kid needs help,
right.
Whatever, right? The other thing we look at after that is long-term care, medical coverage. Do you have that in place should you need it?
Yeah.
And then after that, we've covered those three legs of the stool you like to talk about. The fourth leg is estate planning.
Yeah.
Right? How we want to leave it. And most kids, they don't want your house. They want the money.
They want the money in terms of dealing with
so
that.
Can you leverage better ways to do that? Yes.
Correct. So just know that that's a con. That is one of the drawdowns to it and the drawbacks, that you'd be taking equity out of the property. But you're using it and living with it. And in most cases, most families are probably going to agree with that and say it's your house, it's your money. Use it to live the life that you want to. Like Craig said, let the house take care of you now. Next slide. Right, so what Craig and I try to do is help everybody have more of what we call a clear vision of that road. And some aspect to this is trying to figure out, like Craig said, where are you in terms of your financial situation? What do you have or what do you need? And for that, like he said, understanding what your living expenses are when you're in retirement, or factoring how much it's going to cost you to be living is a big factor. How are your assets going to generate that income for you? Do you have separate things set up to cover, like we talked about, liquidity, healthcare, assisted need, those factors? And then when we get to it, that last part of, is there a bucket that's set up to go to the next generation, should you choose to.
Absolutely, and I think every time you're thinking of these big financial decisions, Tom, you should always be trying to work with a professional advisor, right? You don't go down to, the local coffee shop and talk with your buddies and ask them what they did, right? Because everybody's situation is different. You really need a plan that's built around what's important for you and where you want to be.
Next slide. And the way we do that and what we offer to everybody is what we call the roadmap to financial awesomeness. And what that is, it's a visual plan. It basically shows where you're at. What's the stuff that you've got? What are all of those assets? And the way we sort of have that conversation with everybody is talking about where are you putting those assets? How are you dividing them up? Or how are you designating them? Are they income generators? Are they for liquidity? What about healthcare? And then lastly, that legacy bucket. How have you broken all of that out? If you have, if you haven't, this lets you see it sort of in a visual map that tells you, okay, wait, I can use this, or I can use that, and I can position it this way and build it out so that you know how you're handling all of that. Next slide. If you ever have any questions, ever want to go through any of it, you can certainly reach out to us. You can visit the website. Again, it's www.ariesfoundation.org. If you ever have questions, you can just shoot us an email. It's info@ariesfoundation.org. We're happy to answer any questions. We're happy to try to give any advice or guidance that we can on a variety of these topics, but specifically for retirees as you're getting close, either pre-retiree, at retirement, or past that. Like, how are you setting all of this up? And have you done it? Have you looked at it? And have you thought about, gee, this is what my plan is going to do ultimately?
Right, right. And don't forget to visit our channel at New TV.
Yes, and certainly for those watching, you can see the other presentations that we've done, the other episodes of Think with a Drink. But on that note, we want to say thank you and have a great evening.
By the magic of radio, we're going to span the breadth of the United States and take you to a little fella named Jimmy. Jimmy is suffering from cancer.
In May of 1948, a breakthrough against cancer was discovered. The power of everyday people. People by the hundreds of thousands reaching into their pockets for extra change, saying, "I am Jimmy," and changing the history of cancer treatment, making a promise to patients at Dana-Farber Cancer Institute. We are here. We will fight this together. We will never give up. Funding research and saving lives in endlessly creative ways. Joining doctors, researchers, and scientists in one resounding voice saying, "I am Jimmy."
People coming together, the nickels, the dimes, the dollars, become millions of dollars, and all of a sudden, I'm standing here today.
When my wife had cancer, doing the Jimmy Fund Walk gave me an opportunity to fight cancer with her.
When the doctors said that everything looked clear, I felt like, oh, after this, I'm going to have a dance party.
Now we're able to cure more than 90% of the kids with the most common type of leukemia.
Cancer is relentless, but we're making more progress than ever because we know who we are.
I am Jimmy.
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 We're all Jimmy.
After 15 years of smoking, Eva Marie quit. There's a new lung cancer screening that could save her life. You stopped smoking. Now start screening. Learn more at savedbythescan.org.